European powers, colonial powers at the time, they would have invested a lot to bring civilization, to bring development, to the territories they colonized. And often there is this view that, and it's a myth, that the metropole invested a lot of money in the colonies, and sometimes people thought that that money could have been better spent, in the metropole. But in fact, this view, for me, betrays an ignorance of how capitalism works, and especially what I would call monetary imperialism, because the monetary dimension is really important, because generally it's a facet that is not well understood, and that's why people generally think that the money could circulate across boundaries, but it's more complicated than that. In fact, colonial administrations functioned on the budget balance principle, meaning that they had to spend what they collected in taxes. And this is the ancestor of the neoliberal so-called sound finance. So the colonial administrations spent what they extracted in taxes and forced labor. There were very little transfers from the metropoles. And when these transfers happened, generally the financing came from bond issuances. That means the metropolitan government would issue bonds, and not that their spending or their subsidies, etc., would not come from taxes collected on metropolitan citizens. Sometimes the metropolitan government would provide guarantees to the colonies so that they could issue debts in foreign currency. But these debts were often serviced by the colonies themselves from the exploitation and theft of their labor and resources, and often they mostly benefited the colonial interest, not the subjugated population themselves. And today we could say that we see the same error being made, because rich countries, when they spend on aid, generally it could be seen as a drain on national resources, while the reality is that aid will often be dispersed to benefit the national private sector in rich countries. So the attention is generally focused on public balance sheets, that means government balance sheets, to the exclusion of private sector balance sheets. That means the government will generally spend, but in fact, when the spend is earmarked for the colonies or for developing countries, in fact, the spending will go to private companies in the domestic economy. That has been the logic since the colonial time. And here there is a very interesting book recently published by a French economist about the French Empire, the cost of the French Empire. And this is one of the results. Over more than a century, between 1833 and 1939, colonial domination cost the metropolitan taxpayer only 0.5% of national income on average and annually, bearing in mind that at all periods, military expenditure accounted for more than 80% of the budgetary costs of the empire. And we have a similar results in the case of the Belgian, so-called Belgian Congo. In the case of the Belgian Congo, the military conquest, had involved very low cost. And when this happened, generally the contribution, so-called contribution by imperialist powers, colonialist power, to the colonies they colonized had been negligible in absolute terms and inexistent in net terms. An authoritative study on the fiscal cost of Belgian Congo, now currently called the Democratic Republic of Congo, by Steingers, published in 1957, concluded the Belgian pensions budget alone constitute each year for Belgium a burden almost double that which the Congo has caused in 70 years. So that means there has been no cost at all to colonize Belgian Congo, and there have been many benefits, and those benefits were generally reaped by Belgium as a nation, but also the private capitalists in Belgium. So what is also important to acknowledge is that generally the metropolitan government spending for the colonies generally translate into net financial wealth for metropolitan private capital. And here I offer a quote of a French intellectual, Raymond Aron, a philosopher actually, who was talking in 1959, 1 year before the independences in Francophone Africa, about how government spending earmarked for the colonies generally translate, franc for franc, into private profits, French private profits. And he was saying this: the major fact that I would like to emphasize is well known to everyone, but I think it's worth thinking about. the circuit of payments between the metropolis and the territories of the community, community means empire basically, involves two movements in opposite directions and of a similar amount. To give you an idea of these figures, in 1957, excess public transfers, that means public spending, from the metropole to AF. AF is the French West Africa, so the French Empire in West Africa, amounted to 70 billion, and excess private transfers to 68 billion francs. In other words, locally, public transfers from metropolitan France have a limited incentive effect on the development of the African economy in the strict sense of the term. European economic chunks linked to the metropolitan economy are formed locally. A fraction of the African population is integrated into these chunks, but the majority of the population remains outside this European economy, so that the surge in imports that could theoretically occur does not happen, precisely because an economic and social mechanism leads to the return of public funds to metropolitan France through the intermediary of French recipients of orders or salaries. So basically, he was saying that when the metropolitan government spends for the colonies, in fact, this spending will feed contracts for private capitalists in France, and the amount that is net spent by the government generally will translate franc from franc as profits for French private capitalists. But what is interesting here is that he talks about the returns. There is a economic and social mechanism that leads to the returns. In fact, there is no such mechanism because the money never left the French territory, in the sense that physical money, the cash, the coins, the banknotes could circulate across boundaries, across borders. But money in itself is an electronic entry in bank balance sheets. So whenever a euro is issued, the euro will be, an electronic entry in the banking system of the Eurozone. And same thing for the US dollar, same thing for any other currency. So that means that money in itself as an electronic entry does not cross boundaries, does not cross borders. So whenever the state spends, in fact, it credits the bank accounts, in the metropolitan territory of the private companies, which will reap, the benefits of government spending. So money does not return. The money has never left the continent, the European continent. So what has left maybe was physical resources. Technicians, experts, some raw materials, and maybe some equipments, etc. But the money itself always remains within, the banking system that issued it. So it's really important to understand that whenever people talk about spending for the benefit of abroad, that spending will always remain in the banking system of the the country that grants this aid. So this was a brief reminder about some aspects of colonialism, that it has been a project to extract resources from countries, territories that have, resources that are desired by the most dominant countries. So part to the Bretton Woods legacy. In fact, the current international monetary and financial system or financial order was born in 1944 following the United Nations Monetary and Financial Conference held at Bretton Woods, New Hampshire. According to Richard Pitt, author of this book, Unholy Trinity, the IMF, World Bank, and WTO, World Trade Organization, IMF stands for International Monetary Fund. According to this author, this event, hosted by the U.S. Treasury Department at Bretton Woods in 1944, brought together delegates from 44 allied and associated nations and a neutral country, Argentina. Many delegates did not speak English, the official language of the conference, and the sophisticated issues discussed remained unintelligible to many. Bretton Woods merely formalized previous agreements between the British and the Americans. The conference followed 2.5 years of negotiations between the treasuries of the USA and the United Kingdom. And the Bretton Woods Conference laid the groundwork for the US-centered economic and monetary order that emerged in the aftermath of World War II. The conference's original sin, if I could frame it like that, was that it did not reflect the economic and political concerns of most countries in Africa and Asia, most still under colonial rule, and these countries were not represented. In fact, the 1955 Asian African Conference of Bandung gave voices to the nations that the mainly Euro-American Conference of Bretton Woods had excluded. The representatives of 29 countries gathered in Indonesia to discuss what they called the problems of dependent peoples and colonialism and the evils arising from the subjection of peoples to alien subjugation and exploitation. This year, we are celebrating the 70th anniversary of this Bandung Conference that gave voice to the nations that were excluded by the Bretton Woods Conference. It's a fact that the Bretton Woods system led to progressive policy measures, let's say, for example, capital and trade controls, selective and strategic industrial policy during the 3 following decades after World War II, 1945 to 1975. But I would add that this system was and is still based on the imperialist principle of US Western might is right. For me, it's a pure system of power. Because generally most of us like the idea of democracy, the idea of equality. And generally this translates into this principle of one person, one vote. But that's not how the international monetary financial system works. It's not either the principle of $1, one vote. This principle would have meant that we are living in an oligarchy. But this system is not even an oligarchy. It's a system of pure power, because if it were a system of oligarchy, $1, one vote, you would see that countries would be represented depending on their level of economic development. But that's not the case. It's just a system of pure power, as I will try to show. The first example is with France. When the IMF, International Monetary Fund, and World Bank were created, the quotas and voting rights of member countries had to be determined. So voting rights to take decisions at the IMF and World Bank, and quotas are the share they have, and also the quotas determine the amount of loans countries could receive, for example. And in terms of IMF quotas, France, whose economy had been ravaged during the war, was supposed to be in the 4th place behind the USA, the UK, and China. But France under De Gaulle threatened to withdraw from the Bretton Woods system if it did not occupy the 3rd place ahead of China. The United States, the nascent hegemon at that time, eventually agreed to this request. Unlike other countries, members of the IMF and the World Bank, France did not pay its IMF quota in francs or gold. Instead, the French government issued an interest-free franc-dominated treasury bond. In 1947, France became the first country to receive a loan from the World Bank and to draw on IMF resources. From 1946 to the present day, the International Monetary Fund has had 12 European managing directors. 5 of them were French, who have held office for a total of 44 years out of 79. I'll come back to this. And a second example is that there is a Euro-American Pact regarding the Bretton Woods institutions. And since the Bretton Woods Conference, the US and Europe leaders agreed that the managing director of the IMF is chosen by European member governments, while the first deputy of the IMF managing director is appointed by the United States, which also chooses the president of the World Bank, always a US citizen. The only time it wasn't a US citizen, it is during an interim period. So here you could see another example of might is right, the principle that prevails within the international monetary financial system, the quota shares and veto power. Normally, we are not in a democratic system, but if you were in an oligarchic system, $1, one vote, normally the quota and voting shares would be correlated with the level of economic development of countries. But that's not the case. You could see here, for example, the BRICS countries, that means BRICS countries, Brazil, Russia, India, China, South Africa, and the new members, Egypt, United Arab Emirates, Ethiopia, Iran, Saudi Arabia, they have more or less 18% quota and voting shares at the IMF. But this is half their share of global GDP. In 2023, one GDP is measured in current international dollar in purchasing power parity. Now you compare that with 4 countries, France, Germany, United Kingdom, and Japan. These 4 countries, they represent something like 20% of IMF quota and voting shares, yet they only represent 10.8% of global GDP measured in PPP terms. See, and now you have the United States. The United States more or less have a share of quota and voting shares more or less, in line with its share of global GDP. But the thing is, decisions at the IMF are taken at 85%. And the US has a voting share of a bit less than 17%. So that means that the US has a veto power. So any decision that the US does not like will not go through because of this implicit veto power. And we could also say the same for the EU as a whole. When the EU countries gather together, they also have a kind of veto power within the World Bank and the IMF. So this is a European and American pact since 1944. And this system is not democratic, it's not an oligarchy, it's just a system based on pure power. And you could see that with China. China represents something like 19% of the global GDP. Yet the quota and voting share of China is 3 times lower than its share of global GDP. If it were in an oligarchy, China would have something like 90%. But the US says, oh, we will never allow China to have voting and quota rights that would be, correlated with Chinese weight in the global economy. So this is a system of pure power. And you could see it also in the principle of the SDR allocation, which is based on power, might, rather than need. Created in 1969, the special drawing right is an international reserve asset. So it's not in currency, it's a reserve asset to supplement the official foreign reserves of IMF member countries. So they're central banks. So they could use the a special drawing right to have access to the other currencies of the IMF member countries. So for example, if my country, Senegal, receives SDRs, my countries could use it to convert it to obtain US dollar, euros, and other currencies. So the value of the SDR is based on a basket of 5 currencies: the US dollar, the euro, the Chinese renminbi, yuan, the Japanese yen, and the British pound. The allocation of SDR, the distribution of SDR, remains based on power and historical legacy rather than need. It benefits mainly the government of core countries that do not really need this source of external financing owing to their greater degree of monetary sovereignty. Most of the countries that receive the SDRs do not need it. I mean, the US does not need the SDRs. The EU, Eurozone countries do not need the SDRs, but these countries receive most of the SDRs. So the SDR latest issuance was in 2021. 650 billion SDR were issued. Developing country, excluding China, received 173 billion. And for low-income countries, it was only 9 billion. And this figure, 173 billion, represented 12% only of expected public external debt service for the period 2021-2025. Africa as a whole, as a continent, 54 countries, received less SDRs than Germany alone. And Germany does not need SDRs, but African countries need SDR. So this system of SDR allocation also fits this pattern of might, of power, rather than need or equality. Now, part 3, the international monetary financial non-system. This international monetary and financial system revolves around what I would call a key fiat currency standard. You know that after World War II, the dollar was the dominant currency. The United States, dominant commercial, industrial, and economic power. And at that time, the international system was based on, fixed exchange rate regimes. Most of the currencies worldwide were pegged against the US dollar, and the US dollar were pegged against gold at a fixed rate. So this was called the gold exchange standard. And this system has been abolished, let's say, at the beginning of the 1970s. So that means that since the 1970s, the currencies, most of the currencies, in the rich countries, they float freely between themselves, and they are not pegged to gold to any other metal. So what backs in brackets, quote unquote, these currencies are, the economic might, the fiscal powers of their state, but there's nothing backing the US dollar or the euro except for the economic might and the fiscal powers of the countries issuing these currencies. But the thing is, these key currencies organize international payments. So that means if you want to import, to buy foreign goods, you need to have access to these key currencies. Otherwise, you could not be able to buy your imports. And so this is a structural constraint on developing countries. And you could see that here, a figure from the IMF called the currency composition of official foreign exchange reserves. It's the amount of foreign exchange reserves, official foreign exchange reserves, held by central banks across the world. You could see that the dominant currency held by central banks across the world is the US dollar, with 57.4% of all foreign exchange reserves held by central banks. 20 years ago, it was 70%, but still, it's a very important figure. After that, you have the euro, 20% of all foreign exchange reserves held by central banks. After, you have the Japanese yen, 5.8, pound sterling, 5%, the other currencies, 4.5, Canadian dollar, 2.7, Chinese renminbi, 2.2, Australian dollar, 2.3, and very small amounts for the Swiss franc. So these are the dominant currencies in the sense that they are held as official foreign exchange reserve by central banks. So these are the key currencies, and these are fiat currencies, as I said, because they are not pegged to any metal or to any other currencies. So they are just quote unquote backed by the fiscal powers and the economic might of the government that issue them. And so there is an asymmetry between the issuers of key currencies, especially the US dollar, and the rest of the world. The countries that issue the key currencies, they have an important advantage. Their eventual external payment deficits are self-financing, as they could buy their imports in their national currency with generally limited impacts on the stability of their foreign exchange rates. We talk a lot generally about trade deficits, trade balances, etc. But when you are the US economy, most your payments, external payments to buy your imports, for example, are made in US dollar. So that means that in the case of the US, there is no genuine distinction between domestic payments and external payments, because all these payments happens in US dollar. So any payment by the US economy will stay in the US economy because generally it's paid in US dollar. So deficits are self-financing in that way. It is as if, for example, if I were to take a simple example, if you go to your baker to buy your bread, in fact, when you buy your bread, you are in a deficit, financially speaking, because you have to pay money. If you pay, for example, I don't know, €3 to buy your bread, you have a deficit of €3, but you have a real goods, you have the bread. In the case of the United States, in fact, they will record a deficit in payment, but it's only a deficit in payment, and the counterpart is the real goods received by the US. But I will elaborate on that. But by contrast, countries whose currency don't have the status of reserve assets, they often accumulate deposits denominated in key currencies in order to make external payments and stabilize their exchange rate. So for these countries, there is a clear difference between domestic payments and external payments. If they want to buy their imports, they will have to accumulate US dollar, euros. Otherwise, it will not be possible for them to buy their imports, because imports are invoiced in US dollar or in euro, generally speaking. So this system, this asymmetry, results from the fact that the international monetary system does not allow a free conversion of payments between the various currency issuing countries. And you could make here a parallel with what is happening at the domestic level. At the domestic level in any country, you have, a monetary pyramid, in the sense that the banks, they will issue deposits, and the deposits between banks and the transaction between banks generally will be settled at central bank level, so that deposits between different banks could exchange at par without any significant transaction cost, because at the central bank level, there's a system to clear payment between banks. In fact, in the current system, it is called a non-system because you don't have this form of clearance of, of different, payments coming from different countries at the international level. People like John Maynard Keynes wanted to put in place an international clearing union to address this kind of issues. But, in fact, Keynes was not followed at the Bretton Woods conference. So that's why we have this kind of international monetary financial loan system where most of the countries are obliged to accumulate other countries' currencies in order to meet their external payments. So that means that the key fiat currency standard creates a permanent transfer problem for the countries of the South. That means that for these countries, their ability to spend in national currency to pay for their imports and to pay for their financial debts in foreign currency is limited by the availability of foreign or hard currency. So if you want to repay your debt or if you want to buy your imports, your national currency will not help you. You need to have, foreign exchange reserves, foreign exchange earnings that allow you to pay for your imports and also to reimburse your financial debts in foreign currency. The obligation for countries in the South to accumulate US dollars and other key currencies in order to be able to make external payments is the main foundation, according to me, of their indebtedness in foreign currency and the external debt crisis that go with it. Here you have a quote from the French economist Jacques Rueff, who was a critic of the international monetary financial system, the key fiat currency standards. And he was a vocal critic of the US dollar exorbitant privilege. The concept of exorbitant privilege was created by the French Minister of Finance, Valéry Giscard d'Estaing. He was a French Minister of Finance under de Gaulle, and de Gaulle was against, US dollar hegemony, because with the US dollar, the US could buy goods, services, financial assets abroad just by credit, by issuing US dollars. And the other countries, their central banks would just have to accept these US dollars. But de Gaulle opposed that to some extent, and some French economists as well. And the concept of exorbitant privilege was, kind of epitomized in this quote by French economist Jacques Rueff. He wrote, "If I had an agreement with my tailor that whatever money I pay him, he returns to me the very same day as a loan, I would have no objection at all ordering more sweets for him." So this means that the countries having trade surpluses vis-a-vis the US, they accumulate US dollar deposits because they are paid in US dollars. So this remains in the US banking system. And generally, they do not need these US dollars to pay for the exporters, because the exporters will be paid by creating domestic money, and they will be paid through such mechanisms. So if you export, for example, cars to the United States or given technology to the United States, let's say the German economy will benefit from US dollar deposits, but the German exporters will be paid in euro, because the euro will be created as a counterpart to these US dollars. And that's how it works. Now these US dollars will stay idle. So the Federal Reserve will say, the central bank of the US will say, oh, what do you want to do with this US dollar? Because you have no returns on it. So the German nation or other exporter countries, China, Japan, they will say, we are going to invest them in US Treasury bills, because at least we'll have some returns. So if you are in a position of net exporter to the US, that means you are transferring real goods to the US quasi gratis. This is the meaning of the exorbitant privilege. By contrast, when you are in deficit position, like many in the global South, this country generally, when they don't have enough foreign exchange, when they are in a deficit position, meaning that they don't have enough foreign earnings to pay their debts and also pay for their imports, what happens is that the IMF and World Bank will come to impose them austerity policies and policies that denationalize further their economies, by means that they will privatize the economy for the benefit of foreign capital. So that means that the global South countries that can aspire to escape from debt crisis and the resulting austerity policies are those rich enough to deliver goods on a permanent and quasi-free basis to the US economy, to the rich world in general. So this is also a continuity with colonialism, in that you have an international monetary and financial system that ensures that, the countries that are resource rich, like, for example, oil producing countries, when they export a lot to the global north, they have US dollar deposits, etc. But these US dollar deposits, they will basically be used to buy, US treasury bills, basically, while the exporters will be paid by, creating the domestic currency in exact proportion to the US dollars, you see. So the situation is like heads I win, tails you lose. If you are in a creditor position vis-a-vis the United States, you're transferring real goods quasi freely to the US. If you are in a deficit position vis-a-vis the US or rich countries, the IMF and World Bank will come to say you have to sell off your assets, you have to go through austerity policies, etc. So that is the system in which we are living. And one thing also to note is that the countries in the global south that escape debt crisis generally, in the case of Africa, for example, it's the countries that export fossil fuels. So that means that paradoxically, the countries that escape debt crisis are those who are, exporting, products that are harmful to some extent to the environment. That means fossil fuels. So this is a paradox of our system, and for me, it shows that we could not achieve climate goals by remaining in this system where countries are obliged to earn, US dollar before being able to trade with the rest of the world. So that will, incentivize countries to continue to export fossil fuels and so on. So the external debt crises are a structural phenomenon. Their recurrence in the global south is therefore not a random phenomenon. This is a necessity of the international monetary and financial non-system. The global south countries are handicapped first by their specialization in the export of commodity and low value-added products, which contributes to cheapen their labor and reduce their potential foreign exchange earnings. And second, the relatively high cost of foreign capital, especially loans, credit, due to exaggerated risk premiums that are based on biased perceptions by credit rating agencies about the solvency of African governments. If some African government would like to have access to international capital markets, generally they will be, evaluated, assess their solvency by credit rating agencies based in the global north, and generally they will exaggerate, the solvent, the solvency risk of African government. There have been articles published about that, showing clearly that when you take into account all factors, all relevant factors, you see that there is a bias against African governments when they issue debts in international capital markets. When for example, Greece was in crisis, Greece was able to, Greece was subjected to high interest rates, high yields on government bonds. But still, during that period, African countries had, high rates of economic growth, but still they were subject to high yields on government bonds. The other thing is that there is no functional sovereign debt restructuring mechanism at the multilateral level. So that means that if countries, for example, had problems to repay their external debt, there should be an national mechanism to allow to address that in a way that preserves their developmental potential, their output, their unemployment, but that's not the case. What we have is ad hoc restructuring mechanisms, generally under the aegis of the International Monetary Fund, and generally they are not up to the scale of the problem. So what happens is that deficit countries usually impose punitive conditions, austerity, privatization, and the sell-off of their strategic assets to foreign investors. And also financial liberalization, meaning that you have to open your capital account, allowing foreign investment to come in your country, and also speculative finance to come into your country, and this generally tends to exacerbate financial volatility and vulnerability. But we could have thought of a template for a debt restructuring mechanism that is pro-development, and Germany benefited from that because Germany include debts linked with the two world wars, World War One and World War Two. And in 1952, there was something called the London Agreement on German debts. And this agreement provided very favorable conditions to the Germany to repay its debts. So 50% of German external debt was cancelled by its creditors, which included countries, in the former colonial world: Sri Lanka, Pakistan, Cambodia, Argentina, Egypt, Belgium, Congo, Cameroon, Malawi, Zambia, Zimbabwe. All these countries accepted to cancel German external debt. The external debt could be serviced only when Germany recorded trade surpluses, when Germany was in position of surplus. And the external debt service was capped at 5% of exports. Now you could see that in some countries, it could be even higher than 20%. And the interest rates on German external debt were capped at 5%. In many developing countries now, it could be higher than 10%. So Germany could eventually repay its external debts in domestic currency. This is not allowed to most developing countries nowadays. And there was also this possibility to suspend payments and renegotiate these terms, called review clause, in case Germany faced circumstances affecting its capacity to pay its debt. So all of this was, all of these conditions were given to Germany so that Germany would not have any problem, in developing, its industrial base, etc. The debt would not be a burden on German economic development. And the Allied powers allowed Germany also to pursue import substitution policy and helped with grants in hard currency. If the developing countries now had that, debt restructuring process would be pro-development, but it's not what we have. What we have is punitive austerity policies by the IMF and privatization and so on by the World Bank. But the one thing to say also is that the Global North can afford to cancel Global South's foreign debt stock. Because, when you look at the numbers, you see that Global South's foreign debt stock is really negligible to some extent. In 2021, the public external debt, generally what is called public and publicly guaranteed external debt of the low and middle income countries, we have 131 countries at that time in 21. And this excludes China, Russia, and India. Their total public and public guaranteed external debt amounted to 2.6 trillion US dollar. That means 2,600 billion US dollar, which was less than the federal debt of Germany alone. So that means that the cancellation of the public external debt of the South has never been a financial problem, a matter of affordability for the countries of the North. If they wanted to cancel it, they could do it. But it's not in their interest to do that, because debt is a weapon of domination. And the Global North, the rich countries, have been using that, especially through the IMF and the World Bank, to impose, as I said, austerity policies, and also to impose financial liberalization and also the privatization of the most strategic sectors in the Global South. So whenever we talk about this debt issue, it's never a matter of affordability, but it's a political matter of saying that we do not want to get rid of the debt system, because that's what allows us to maintain our domination over the Global South, you see. And but canceling the debt stock is not enough for me. And that's one point where I, stand apart, many economists, even progressive economists, because they only talk about the debt, and they would criticize, many companies, the investors in the bond markets, etc., that they are greedy, all these kind of things, which are true, generally speaking. But the thing is, they never talk about foreign direct investment. And when we talk about foreign direct investment, that means investment in productive assets. And generally, this is measured by having a control of 10% of assets in a foreign country, of a company in a foreign country, you see. But in the case of Africa, our economies had been bled more by profit and dividend repatriation by foreign direct investment than by the debt service itself. And you could see that in this graph. You could see in green, gray, you have the total interest payments. That means the external payments, external interest payments on the debt stock, the external debt stock. And this has been any year lower than the debt service, which is normal, because the debt service is interest payment plus the principal. But you could see that between 2005 to 2018, the primary income on FDI, primary income means the returns on foreign direct investment. That means the profits, the dividends by foreign direct investment in Africa had been systematically higher than the debt service. So from a developmentalist perspective, the reasoning we could have is that if all this money that is repatriated abroad were it was invested, let's say, in agricultural sector to have, let's say, food sovereignty, in industrial policy, in industrial sector to have, to build a domestic industrial base and to have more energy self-sufficiency, better infrastructure, maybe the African countries would not have been in the need to issue debt in foreign currency. For me, this is one of the reasons why most of our countries issue debt in foreign currency, because they are bled by these huge, transfers of profits and dividend. And most of the economists, even the progressives, they do not talk about this aspect, which is really an African problem. And this is also raises, stakes about, the taxation of transnational companies, etc. Here you could see, the examples of two countries that defaulted on their debts, Ghana and Zambia. You could see that for both countries, the primary income on FDI in blue, primary income is returns on foreign direct investment. The primary income of FDI had been systematically higher over the period 2000 to 2020 in Ghana and in Zambia. All of these countries, they defaulted on their external debts. But most of the discourse is just about what is here highlighted in red. That means the debt service. They will say, oh, it's too high, you have too much interest rate. But the thing is, if what is in blue was controlled in some sense and was invested domestically, maybe African countries would not have needed to issue so much debt in foreign currency. And the case of Zambia is very interesting because as a copper producing country, Zambia benefited from debt relief in the mid-2000s, because in the mid-2000s there have been schemes to cancel the debt, external debt of developing countries. And between 2000 and 2006, the external public and publicly guaranteed debt stock in Zambia declined from 4.4 billion, that means 128% of gross national income, to less than 1 billion US dollar. That means less than around 7.4% of gross national income. So the debt stock, public debt stock, decreased by 81%. But this debt restructuring by the IMF was conditional on the privatization of the copper sector for the benefit of Canadian mining companies that also enjoyed favorable tax and legal terms. With the commodity boom, the FDI income skyrocketed, deteriorating further the primary income account. And so the cumulated FDI income flows from 2000 to 2005 stood at 1 billion compared to 5.49 billion for the period 2006-2010. So on the one hand, the debt stock was cancelled, but in fact, the foreign payments increased due to, the high levels of, profit and dividend repatriation in Zambia. And this is just one aspect. The second aspect is the plunder. The real resource theft, the plunder of the resources, because the money, the US dollar have never been in Africa. They always have been, in the US banking system. But the thing is, the real resources, I mean, the copper, the oil, the uranium, etc., they are stolen through accounting tricks from the continent and, transported abroad. You see, and when you measure that, you could see, for example, between 1970 and 1991, Zambia lost 10.6 billion US dollar. And this represented 354% of its GDP at the time in 1991. Between 2001 and 2010, 8.8 billion US dollar lost by Zambia. Between 2013 and 2015, 12.5 billion US dollar, according to the UNCTAD study. By comparison, the Zambian public external debt stock amounted to only 1.2 billion US dollar in 2010 and 12.5 billion US dollar in 2021. So if all these resources that have been stolen, were appropriated by this country and invested, in sectors that would have created more industrial development, more infrastructural development, maybe Zambia would not have been in a need to issue debts in foreign currency. And here you also have a very interesting report from the IMF. And this followed the Zambian default on the 42.5 million coupon payment in November 2021. So the Eurobond amounted to 42.5 million and the coupon payment to 1 billion. And Zambia defaulted on November 2020. And in its 2023 country report, the IMF wrote, Zambia's balance of payments has historically been characterized by large leakages in the form of sizable private sector's assets held abroad. These outflows average about 1/3 of copper exports over the last 5 years. and have been as high as about 20% of GDP in 2012 and 2014. 2012 GDP was 28 billion. So these outflows have largely offset the significant FDI inflows of the early 2010s and contributed to the gradual depletion of reserves before the 2021 SDR allocation. The report added that 50 to 90% of copper exports in 2020-2021 were not repatriated, and that understanding how these processes were used is key to completing the assessment of the possible data gaps. Many people talk about the debt issue in Zambia without factoring this aspect, that the Zambian, copper sector is not controlled by the Zambians themselves, and there are huge leakages, as the IMF said, which have not been taken into account. And if the country had control over that, maybe the country would not have been in the need to issue debts in international capital markets. And this is a general pattern. You could see that in this graph. This graph comes from the UNCTAD, United Nations Conference on Trade and Development, and it shows for the period 2000 to 2017 that there have been a net transfer of resources from developing to developed countries. Most people would assume that the developed countries are helping the developing countries. They are transferring development aid. And this graph, you could see that net development aid, has stayed on the same line, 100 billion every year, and it has not moved. Between, let's say, 2007 and 27, it's every year 100 billion net development aid. But you could see here in the graph in blue that, there has been a persistent pattern of net resource transfer from developing to developed countries. And this net resource transfer, are constituted on the one hand with, these net income payments, that means these profits and dividend payments. And there's also the interest payment on the external debt, but also the foreign exchange reserves accumulated by countries like China and so on. So that means, you have debt and the equity side, and you have also these countries that are transferring net real goods to the, to the rich world, because they have been accumulated large, levels of foreign exchange. Here also you could see it. These are, net income payments. When we talk about net income payments, is the net returns on foreign investment. And you could see that there are 3 countries that benefit a lot from their investment abroad. You have the United States. In 2018, the net returns from foreign investment represented something like 2% for the US, 3% for Germany, and 4% for Japan. So in some sense, you could say that these countries, they own a share of the production abroad of foreign countries. And in some sense, you could see it as an imperial mechanism, in the sense that they benefit from a tribute from the rest of the world. Every year, they will receive between 2 and 4% of their national income from their investment abroad. These are net figures, so that means what you receive minus what spends, what you receive less what you transfer. In the case of low and middle income country, you could see that, well, they are they're transferring net income to the richer world, so they are in a position of a deficit. So one note on development aid, because many people in the global north think that development aid is helping the global south. In fact, either development aid is a kind of imperial mechanism, or it doesn't address the structural roots of the problem, like this net resource transfers. And here we have 2 interesting quotes. The first is an investment banker, Eugene Black, who was the 3rd president of the World Bank, president and chairman of the World Bank. He said in a publication in 1965, how foreign aid programs constitute a distinct benefit to American businesses. The 3 major benefits are: first, foreign aid provides a substantial and immediate market for the US goods and services. Second, foreign aid stimulates the development of new overseas markets for US companies. Third, foreign aid orients national economies towards a free enterprise system in which the US firms can prosper. We have another quote coming from a USAID, US Agency for International Development report, which has been removed since then. And recently, we all heard that the USAID has been defaulted by the new American government. In that report, it was said the principal beneficiaries of America's foreign assistance programs has always been the United States. Close to 80% of the U.S. Agency for International Development contracts go directly to American firms. Foreign assistance programs have helped the United States by creating major export markets for agricultural goods, new markets of industrial exports, and hundreds of thousands of American jobs. In the case of French, There had been a recent and authoritative academic work on French aid, which lamented what it called the opacity, artificiality, and insincerity of development aid figures. In its development aid accounts, France includes, for example, the private expenditure of its most loyal African head of state. You see, I'm not saying that development aid is bad in itself, or that in general, they are in practice good programs of development aid that had, lasting results. But the aggregate impact has not been, conducive to development because it has been an imperialist tool, or either it did not address, the structural roots, of underdevelopment and transfer of resources from global north to global south. So the last part, so I'll go quickly on this part, an illustration with the CFA franc. In fact, the CFA franc is Africa's last colonial currency, as I wrote in a book, with my colleague and French journalist, Fanny Pigeot. The CFA franc is the acronym for a currency created in December 26, 1945 during colonial times. Originally, the acronym CFA franc meant the franc of the French colonies in Africa. It circulated in the sub-Saharan Africa part of the French colonial empire. 79 years after its birth, the CFA franc remains a colonial currency, a French-controlled currency system operating in 14 countries. Because there is a legal agreement between the French treasury and the countries using the CFA franc and their two central banks, because you have two currencies named the CFA franc, but they function exactly the same way. You have 8 countries in West Africa, 6 in Central Africa. They have their respective central banks, but they are functioning a similar way, and they have legal agreements with the French treasury, and their countries as well have legal agreements with the French treasury. So France created the CFA franc to obtain more policy space in the US dollar-centric world. This was under de Gaulle. Through the CFA franc, France had 2 advantages. First, like the US globally, France could buy on credit its imports in the CFA franc using countries. So France did not need to have US dollar to buy oil, uranium, cocoa, everything in the country using the CFA franc. It could just, credit franc, for the central banks, and that's how it works. It could buy them on credit. And France had a discretionary control over the foreign exchange earnings of these countries using the CFA franc. So every time these countries would import, things, they would have dollar earnings. These dollar earnings would be deposited at the French treasury, and the central banks would create, the CFA franc to give to the importers to pay them for the imports. But the US dollar would be controlled by France, and this is still the case. I mean, in Central Africa, the France obliged them to deposit at least 50% of their foreign exchange at the French treasury. So the CFA franc originally was pegged to the French franc until 1999. And since the arrival of the euro, it has been pegged into the euro. And the value is at €1 for 656 CFA franc. What needs to be said here is that since the arrival of the euro, the CFA franc is also under the tutelage of Eurozone political and monetary authorities, because there had been a legal agreement in December 23, 1998 between the Eurozone political and monetary authorities and France, saying that if the CFA franc countries want to have a new member, the Eurozone political and monetary authorities should be informed. If the CFA franc has to be devalued against the euro, they should be informed. If also the so-called guarantee that France is supposed to provide, has to change nature or something like that, the Eurozone political monetary office should also be informed. So that means now, since 1999, there have been a double tutelage over the CFA franc by the French government and the Eurozone political and monetary office. So it's no longer alone a French affair. If we still have the CFA franc, this is also due to some extent to to Eurozone political and monetary authorities. So France controls the monetary exchange rate policies because France is represented at the boards of the central bank and also the monetary policy committee, and control their foreign exchange reserves until now, and can financially sanction dissident governments. For example, 3 times, since 2011, France has asked the BCA, or the Central Bank of West Africa, to deprive some governments of their access to their own bank accounts at the central bank and at the domestic bank accounts. And these countries generally they defaulted on their debts, domestic debt and external debts, because they no longer had access to their own bank accounts. And this was instructions coming from the French Treasury to the Central Bank of West Africa. And this central bank, as I said, is in a relationship of legal subordination towards the French Treasury. So the CFA franc countries are the poorest in the world. And, what they, in fact, those who defend the CFA franc, they generally pride themselves of, recording one of the lowest inflation rates across the world. You see, so our average inflation rates annually, that means the evolution of prices, general level of prices from one year to another, is something like 2%. Before COVID-19, the same like in the Eurozone to some extent. You see, that means that we have been recording inflation rates lower than even countries like China, Brazil, United States, etc. You see, so it's very strange to see countries ranked as being among the poorest having such low rates of inflation, despite the fact that they don't have domestic industrial capacities at the domestic level, this kind of things. But using the same currency did not stimulate trade nor attractivity toward investors. If you take, for example, the case of Central Africa, the 6 countries there, between 1995 and 2021, the regional trade in CFA franc represented just 1.5% on average of their total trade. So that means that sharing the same currency did not, create, more trade between these countries. And also, the other countries generally attract more foreign direct investment compared to, CFA franc countries, despite the fact that their currency is backed against the euro and they have low inflation. And you could see, the overall impact in this graph, in the sense that most of these countries, they have either declined economically speaking or stagnated in the stagnated over the long run. Equatorial Guinea, it's a small country, very rich country, oil exporting country. Their best level of real GDP per capita, that means the real income, was achieved, in 2008. It was 14,000 US dollar at that time. It was very high. But by 2022, it declined by 58.2%. Why? This is a oil producing country, and it is one of the only countries across the world producing oil, and that made a choice to peg its currency against the euro because it's using the CFA franc. Equatorial Guinea joined the CFA franc in 1985. Cote d'Ivoire is the biggest country in the CFA franc zone in terms of GDP. Its best level of real GDP per capita was achieved in 1978. That means 47 years ago. And it was something like 300,000. But now it's only 2,400, you see. So its real GDP, its real income declined by 90.5%, compared, to the best level of real GDP per capita achieved in 1978. And this has been the pattern for most countries using the CFA franc. But what is interesting is that all of this is known, but not acknowledged biblically. You see, for example, in 1963, John Fitzgerald Kennedy ordered his Secretary of State, Dean Rusk, to make an investigation about, the CFA franc zone and French relationships with, their former colonial empire. And it's a memo of 90 pages, which has been published, declassified recently. And the conclusion of that report was France's control over the monetary policies and foreign exchange reserve of its former African dependencies, coupled with a host of other trading relationships, enables it to recoup its assistance to these countries. This legacy from a prior French colonial relationship implies a degree of external control over countries' financial and economic policies that would be unacceptable under other circumstances. Dean Rusk, Secretary of State, was optimistic that the CFA franc would be over because he said no sovereign country could ever accept that. But we still have the CFA franc in 2025. And this year will mark the 80th anniversary of this colonial currency. The people at the IMF and World Bank know also how the CFA franc work, but they have been really silent about that. And here you have an excerpt from a former World Bank chief economist, Kaushik Basu. And in his book, Policymakers Journal, he said this, on CFA, my lips are unfortunately supposed to be sealed. the CFA franc is a currency peg that the French had arranged with former colonies in West and Central Africa. Despite the switch over of France from the franc to the euro, the peg now vis-à-vis the euro continues, which gives the European Central Bank an enormous amount of power over these West African economies. The peg cuts down on currency risk, but handicaps the regions in terms of trade and exports capacity. However, this is treated as a topic that you could not even mention in West Africa because it may give ideas to nations like Senegal, my country, to break out of the peg. Before I set out on my West Africa mission, I was advised by my senior colleagues in Washington and also by the communication department not to ever bring up this topic when in Africa. To me, this marks of colonialism. Don't even plant ideas in the minds of the colonized. I violate this structure and raise the topic in my conversation with ministers and central bankers. However, and I regretted later, I did not raise this when the media was present because I did not want to get a phone call from Washington. So all these people know the CFA franc and how it works and why it is detrimental to African countries. And to some extent, this is not random because, as I said earlier, the French have been very powerful at the IMF. The IMF managing directors are always European. For now, they have been always European. And there have been 12 of them since 1946. 5 of them had been French. And between 1963 to 2000, except for a period of 5 years, all the managing directors have been French. And the longest serving managing director have been French. Michel Camdessou, 13 years. Pierre-Paul Schweitzer, 10 years. Jacques Larosière, 9 years. Christine Lagarde, 8 years. Dominique Strauss-Kahn made only 4 years because he was removed from his position after, a kind of a sexual scandal, you see. But as these countries are impoverished by the CFA franc, generally they have balance of payment problems, and generally France will not help them by activating its so-called guarantee, a kind of aid, a kind of overdraft at the French Treasury. France would not give them that. France will tell them, go to the IMF, accept IMF conditions, and you see that these are only 14 countries out of 54, but they received 1/3 of all loans in terms of volume, because there have been 600 loans since 1960, IMF loans to African countries, and 1/3 accrued to CFA franc countries. In terms of nominal value, these loans amounted to less than 90 billion US dollar. So less than 1/5 of the value of total loans to the African continent since 1960. So when we talk about the IMF, when it comes to francophone countries, it's France, it's the French Treasury. IMF and the French Treasury are the same. And to some extent, the IMF could have, talked more about the CFA franc and how harmful it is, but it has not been, its role. So in conclusion, briefly, I will say that in complement to the necessary efforts by Global South countries to have their own house in order, I did not talk about this aspect because I was asked to talk about, the international monetary financial system. But these Global South countries have also to have their own house in order, because external change could not happen, or when it happened, could not be beneficial if you don't have your own house in order. For example, by wisely using your currency issuing power and retreating from neoliberal policies. But at the multilateral level, I would advocate the following measures. First, cancelling urgently the external public debt stock of low and middle income countries, because they need it for their own development, economic development. They also need that to achieve their climate goals. Promote alternative payment systems, allowing trade in national currencies so that countries will not be in the need to accumulate US dollar or euros to buy goods they need abroad. And also facilitate technology transfers, including the removal of intellectual property rights on key technological products. These are 3 things I think that are really important. There are many other recommendations that one could make, but for me, these are really important for the development of most countries currently ranked as low and middle income countries. But this being said, I'm not naive, and I do not think realistically that the Bretton Woods institutions they are reformable in a substantive sense, because as I try to show, they have been historically based on the principle that Western might is right. That's how these systems function. Western might is right. So I think what is needed is an alternative to this Bretton Woods system, and this requires creating parallel and concurrent economic blocks and monetary and financial arrangements that will make the Bretton Woods institutions obsolete. Thank you very much for your attention.
All right. Thank you so much for this really sweeping overview. I think we covered a lot of bases, and yeah, thank you. I really thought I learned quite a lot. Now I'm sure people have questions, and I'd like to now give the floor to some of them. I think we won't have time for all of them as we've gone a little overboard. Uh, But I will just take some. I would maybe ask of the participants to use the reaction to raise your hand. I think it's a button on your bottom right of the screen, if I'm not mistaken. And then I'll either, depending on the scope of the question, take them one by one, or maybe we gather some. What do you think, Ndongo? Does that sound fine?
Yeah, fine, yeah.
Okay. Now, truth be told, I am not sure whether you the permissions are in order. So, Micah, I think you're the first. If you maybe just want to go ahead trying to speak.
Yeah, thank you so much. Okay,
Perfect.
thank you so much for this great presentation. My question is regarding your evaluation of the discussion of West African currency, the ECO, that is discussed since very long time. So I would like to know, how do you evaluate all this discussion and process? What chances do you see in a West African currency, and also what kind of problems? Thanks.
Okay, I think we'll take one more if that's fine. Then Hildegard, go ahead.
Thank you very much for this talk, which was quite comprehensive and gave a lot of information. I have a question regarding this London Agreement on German debts in 1953. You were mentioning countries which were included in debt. How do you say?
Debt restructuring.
Yeah, and there were countries like Zimbabwe and Zambia who were at that time still colonies.
Exactly.
So what do you mean? Were there transfers of commodities, or was this a British decision? Or I was a bit wondering why you were mentioning those countries.
Ndongo, do you want to go ahead? I think there's no other questions for now.
Okay. I will start by the first question, the West African ECO. In fact, since 1983, there have been a project to have a single currency like the euro in West Africa. When I say West Africa, 15 countries, including the 8 using the CFA franc in West Africa. But this project has been postponed several times. It was announced that in 2020 it would be launched, but it has been postponed again to 2027. In fact, there has been, no political will from the countries in West Africa to have this regional single currency. Nigeria is the most important country, I mean, economically speaking, in West Africa and probably in the continent. And Nigeria did not show until now any willingness to have this currency, launch, because Nigeria has its own domestic affairs. The CFA franc countries, most of them for now, their leaders, they have said we prefer to be with the French treasury rather than with our African neighbors. You have a country like Cabo Verde say, oh, guys, we are much more integrated with the Europe than with you guys. So we prefer to stay where we are, because they also have, Cabo Verde has a kind of agreement with the Portuguese government. You see, it's not like the CFA franc, but they have this kind of agreement. And you have a country like Liberia, which is also dollarized countries, because you have the Liberian dollar and the US dollar circulating, etc. And they said, for now, we are observing. So you don't have, political will. The other thing is that they have tried to copy paste the Eurozone. in the sense that they have this kind of Maastricht criteria saying that you have to meet these criteria before launching, the currency, the regional currency. But the thing is, all of these countries are commodity producers. If they don't have good prices for their commodities, in fact, they will not, meet any criteria. And that has been one of the reasons. Every time they said, "Oh, no country meets this criteria, so we have to postpone again." You see, so the methodology does not work because it's fundamentally political. But at the same time, I think it would, if it were to happen, it would create, problems, similar to the Eurozone, with the difference that we have not yet reached the stage of financial integration and trade integration between African countries, because inside the West Africa, the trade is less than 10% of our external trade. Trade within West Africa is less than 10% of total external trade. And the other thing is also Macron also tried to sabotage this currency in 2019, because he made an announcement that, well, the CFA franc in West Africa is over, it will be renamed ECO. But ECO is a short for ECOWAS, Economic Committee of West African States. And these 15 countries belonging to ECOWAS, they said, "Oh, we are going to name our future currency ECO." And Macron illegally appropriated that to create confusion, you see. And when Macron announced that in July 2020, you will have the ECO, most of us knew that we won't have the ECO, because ECO is an ECOWAS project, and you have to go through legal steps, and this is, time consuming, this kind of thing. So what I could say that I'm not optimistic that we will see this ECO currency one day, because, most of the people defending that generally they adhere to neoclassical economists. And so what I would have rather recommended is to have an African payment system, regionally or, continentally, so that Africans could trade between themselves without using, euro or the US dollar. You see, for me, there are many things you could do to achieve the goals of monetary union without having, a monetary union. But that has not been the dominant thinking. About the London Debt Agreement, you're right that most of these countries were under colonial rules. And so the colonizers, they had, claims against the German economy. And it is those claims that they decided to cancel. It was not a sovereign decision from, the colonies themselves, because these colonies could not be sovereign. It's decision taken by the UK, France, etc., to say that in our colonies, there are some claims, against the German economy. We accepted to cancel it.
Very well. Are there any other questions from any audience members, participants? I'm also encourage you to ask questions of understanding, and not feel the need to sort of quote unquote ask smart questions, but also feel free to ask for clarification on anything. Right. Then I might maybe have a final question, but feel free to still raise your hand. And also before I pose my there we go. Then I'll probably just do the repeat round. Just maybe before we take the final questions, I'd point your attention to what my colleague Verena posted in the chat. There's a quick feedback form for those of you who maybe want to leave soon. Please, it just takes a few clicks. Okay, I'll go first with perhaps people who haven't asked questions yet, which is Maximilian and Adrian, and then go back to Mike and Hildegard. So Max, go ahead.
Good evening. Max Schreiger from UCL's Institute for Innovation and Public Purpose. First of all, thank you so much for the very, very interesting talk. You spoke quite extensively about the IMF and the World Bank. I'd be very curious what your views are of BRICS initiatives, for example, the New Development Bank. Do you think that is, in a way, just a different bloc's approach to trying neoliberal colonialism? Or do you think that there's a genuine interest actually in alleviating the issues? What do you think are the perspectives there, especially for developing countries there?
Great. And Adrian, go ahead.
Thank you very much also from my side. This has been a great insight. I have a political strategical question. Who do you put hope into for changing the international financial system? I know it's a big question, but I would be interested what your take on this is, like who are core actors. Yeah, thank you.
Super. Ndongo, is it fine if you take the follow-up questions of
Yes.
okay, then Michael, go ahead, and then maybe afterwards Hildegard.
Okay, thanks for the opportunity and for answering my first question so well. My second question is regarding the conference that you mentioned that will be taking place at the end of June. I don't really have in mind what this conference is about, but maybe you could say again something on, yeah, what kind of hope do you see in this conference, and what kind of discussions will be taking place? Thanks.
Mm-hmm.
Hildegard, please go ahead.
Yeah, okay. You mentioned that the US development aid was also meant to benefit American business. I would like to get your view on the current policy of Donald Trump to skip all development aid and close US aid and so on. Do you see an opportunity for Africa in this move, or is it more a disaster? So what is your opinion?
Okay. Yeah. I start with a question by Adrian. Is the international financial system changing? I would say yes. And it is changing due to, I mean, various reasons. And we have seen the challenge by, for example, BRICS countries, because as you could see in one of the figures of the slides, I mean, the BRICS are underrepresented in terms of voting rights and also quota shares and so on. So they have been trying to do something else, you see. And the Western countries, they also have been making mistakes because they have been weaponizing their currencies and their payment systems. So more and more countries are saying that we could no longer trust, you know, the Western countries, because anytime you accumulate US dollar or euros, they could seize it illegally, etc. This kind of thing. So we have to delink from the system, and that's what is happening. And someone like Donald Trump does not understand what is the exorbitant privilege, because he wants to have trade surpluses against other countries. And when you have trade surpluses as the country that issues the world reserve currency, that means you do not anticipate to create liquidity for the rest of the world. So there will be fewer dollars in the world economy, because when you are in a position of trade surpluses, that means that, well, you are not creating liquidity for the rest of the world, and that's what Donald Trump wants to do. That means to sabotage further the dollar, so that he doesn't understand what that means. So for a variety of reasons, this is happening. But now, and this, I will link that with the question by Schweiger, I do not think that the BRICS project is progressive in itself, because, you know, it's ambiguous. Internally, most of the BRICS countries are not progressive at all. But what is interesting is that they constitute a challenge against, you know, the US centric world, the Western, Western hegemony to some extent. So this creates options for other countries in the global South to have, you know, more balanced, trade relationships, better financial deals, these kind of things. So we have this opportunity, but at the same time, it's an anti-hegemonic project, but not progressive project per se. So it will be up to the countries in the global South, non-BRICS partners, to try to shape that direction in a way that will be beneficial. I was writing in a recent article with Jomo Kwame Sundoram that, you know, what we need is a system that will allow countries to have access to their imports in their national currency. So having more international reserve currencies will not solve the problem of deficit countries. And when you take the case of the New Development Bank of the BRICS, most of their loans are still in US dollar, which is a paradox for, a grouping that wants to delink from the US dollar, etc. So there are a lot of contradiction within the BRICS, but they create opportunity for the global south. And now it's up to the global south, I mean the weaker of the global south, to organize to, have a kind of a bonding moment when they will, impose maybe a new economic and financial order. And about US aid, in fact, the decision by Trump administration to shut down US aid, I think it's a very brutal decision. And I mean, some people have documented very successful programs by the US aid, especially in Africa, etc. And some people speculate that this will create a lot of debts, etc. But as I said, I could not say that development aid in general is bad. Because there have been successful programs, but overall the logic of development aid has been within these imperial structures, that it did not change the logic, but maybe it has from time to time helped a bit, but did not change the logic. So now most of these countries are obliged to do something else. So I would say this is a situation of forced delinking. So it's a crisis, and countries have to create innovative ways to go over this crisis by mobilizing, for example, their domestic resources. And this is possible, but they have not done so because most of these countries which want to challenge the world system, they still adhere to neoliberal principles and also very orthodox views of money. And there are many things these countries could do, but they have not been doing. Now it's time to do what they could do in a sense that will create prosperity for their population. And conference, I think, Simon might talk about it. I think it's end of June conference in this year in Sevilla is the UN Financing for Development Summit. Maybe Simon will elaborate on that. But every time the question I raise is financing for which kind of development? For me, that's a critical issue. Which kind of development, especially in an age of climate and environmental distress.
Yeah, very well. Fantastic questions. Thank you also for your fantastic answers. Since you passed the ball to me, I might as well lose a few words on the FFD4 conference, the Finance for Development conference. Yeah, indeed, it's so the thing about it is its ambition and its scope is very big, it's very large, and more so than other comparable platforms. It's the fourth edition of this conference, and they only happen like once every 10 years or so. And their purpose is to really discuss the sort of systemic questions, right? So really like the rules of the financial order, or sort of the institutions and I've lost my train of thought a little bit, but the thing is that right, and also it's a UN platform. It's right, so it's technically a platform that is theoretically very legitimate because all countries are involved, and it's not within the IMF or name another international institutions where Western rich countries have a larger voting share or anything like that. So there's a theoretical potential with it. I think in practice we should reserve some skepticism to the success and the actual results, but also not dismiss it. Because the thing is, the issues on the table are really in some ways the big issues. The question of debt is on there. The question of I don't know, the role of private investors is in there. The role of the institutions is in there, and so there will be negotiations about the right questions. I think whatever will be the outcome will be disappointing in a lot of ways, but perhaps there will be progress in certain respects. For example, we were all a little surprised, I think, positively end of last year, when at the Summit of the Future, a similar large-scale UN convention, there have been new reforms or agreements passed on international taxation. Right. So steps are possible. What is really needed is large-scale systemic reform. Ozan, you said a comment to that effect, and I agree. And I think in that respect, it would be somewhat disappointing. Yeah, I think it's 7:30. Perhaps we take one more question, if that's fine with you, Ndongo.
Yes.
Quick nod? Okay, perfect. Then Taya, go ahead.
Yes, thank you so much for your talk. I'm in the library, so I hope you can hear me. Can you hear me? Like I'm whispering a bit. Yeah, so I wanted to know if you could explain again how like high exporting countries like China and India are basically like transferring their goods for free or gratis to the US by kind of reinvesting in US Treasury bonds. Like, what's the financial mechanism there that kind of it's like a net zero game for them? Yeah.
Yeah, thank you for this question. Money does not move in some sense. Well, maybe we could be used to the view of seeing the cash circulate, banknotes, coins, but money is just an electronic entry in bank balance sheets. And so that means that the money will never leave the bank sheets. So the US dollar is a sovereign country issuing the United States is a sovereign country issuing the US dollar. So anytime a US dollar is created, this US dollar will remain within the US banking system. So now, when you are China, that means that you are a surplus countries. You export more to the US than you buy from the US. So that means that China will have something like, for example, I would just give a number, to not actual number, just a number, 100 billion US dollar of surplus. That means exported, let's say, 200 and received and imported, from the US 100. So China has 100 billion US dollar of, of trade surplus. Now, the 100 billion US dollar will be held as foreign reserves for the Chinese economy in the US monetary and financial system. And now the Federal Reserve will ask the Bank of China, you have 100 billion US dollar. What do you want to do? Because 100 billion of dollar has been, goods sold to the US. And this 100 billion US dollar, will stay in the current account. So there's no returns for that. And now the Bank of China will say, oh, let's buy, US Treasury bills because it's safe, it's liquid to some extent because China has not been, expropriated from its reserve for now, compared to China, etc. And because the US does not allow China to buy US companies, for example, because otherwise they could have taken the US dollar to buy Chinese companies. That what the US used to do against European countries, for example, in the 1960s, and de Gaulle did not like that. So that means that whenever you accumulate foreign exchange reserves, through trade surpluses, that means that you have an international purchasing power that you are not using productively. You are investing that in financial assets. It's in this sense that surplus countries are transferring, net real goods, to deficit countries issuing, reserve currencies or the reserve currency.
And is this also then linked to that kind of the US is mainly heavily indebted to China, or kind of that US external debts kind of, is that the case, right? Yeah.
Yeah, in fact, people think that the US is borrowing from China. It's impossible. It's impossible in some sense that, the US has monetary sovereignty. It's the most sovereign countries in monetary terms because they have the reserve currency. So what happens is that whenever the US Congress approves the budget, the money is made available for spending for the government. It's just a legal procedure. And now what happens is that, as I said, countries like China, Japan, Germany, they made the choice to be net exporter countries with surpluses. And when you have surpluses, it doesn't generate any income because these surpluses are held in a foreign bank jurisdictions. And you will be asked what you want to do with your surplus dollars, etc. And you will invest them in treasury bills because you have no other way of using them. Otherwise, because the only natural way to use them is to buy more imports, but you are not doing that. See, so China could not lend. In fact, what is perceived as lending is in fact a way of recycling China's surplus. But the US does not need to issue bonds to issue bonds, sovereign bonds. It's a political choice to make financial institutions richer, etc. But for a sovereign country, there is no necessity in issuing bonds. If the parliament agrees the budget, the central bank could credit, the central accounts of the government.
Okay, thank you.
Okay. Thank you for this discussion as well and this explanation. There's a final question perhaps in the chat, and maybe that's a great question to round off on, Ndongo, which is like, is there a particular movement, a particular progressive country, actor of any change that you look for as a pressurizer for change?
Well, if I take the case of African countries, that might sound paradoxical for Western audience, but the most exciting prospects in terms of delinking, in terms of charting another way, in fact, is happening in the Sahel. In the Sahel, you have 3 military governments. They come through military coups, and they have been doing, what people like myself and other before, Pan-Africanist people, that means uniting Africa, having a better control over the resources. They have been doing that in a sense that they have been asserting their sovereignty over, imposed policies by France, and others. For example, they removed military troops. They created a confederation. They are coordinating to have common companies, etc., common industrial policies, common financial institutions. They are planning to have their common, common currency, and they have been also asserting greater control over their natural resources. So these are interesting things coming not from the democratically elected people, but from, military rulers. That is paradoxical for Western audience, but that is what is happening, because there have been also, some issues with the story of democratic transitions within African continent. But, this is an interesting prospect to some extent. But there are many, many challenges, even within each country: climate challenges, development challenges, and also the challenge to create, decent jobs en masse for, for their populations. So there are a lot of challenges.
All right. Ben, thank you so much. I think on that note, let me stop the recording.